gustó bastante la ponencia.
Okay, sí. Son temas además como muy relacionados con las aportaciones que hace la escuela post-Keynesiana, institucionalista. Hay muchos temas muy comunes.
Bueno, ya son las 11. Professor Dallery, should we start? Yeah?
When you want, I'm ready.
Recording in progress.
Okay. Then, welcome everyone. Thank you for being here today. We are glad because we have between us in this virtual world, Professor Thomas Dallery. I'm gonna introduce you, Professor Thomas Dallery. Professor Thomas Dallery is a professor of the University of Littoral, Côte d'Opale. Trabaja en el Departamento de Economía y ha realizado bastante investigación acerca de tópicos macroeconómicos, microeconómicos y economía monetaria. No me voy a extender mucho. I want to say this in English. The session is divided in three parts. The first part, obviously, is the presentation of Professor Thomas Dallery. The second part is a comment made by Professor Corona. And in the last part of the session, you know that you can ask a question, and maybe we are going to have one or two rounds of questions. Without hesitate, I'm going to give you the word, Professor Thomas Dallery. Professor Thomas Dallery, you have the stage for you.
Hello. Thanks for the organizers for inviting me. I'm starting to share my screen, so I'm hoping that you can see it right now. So the first thing I want to say is that I'm sorry for my bad English. I hope that my English could be better, but sadly, I'm like most of French academics. I've got a bad teaching of English, so my English is too limited. But I hope that you will be able to follow what I'm saying today. So the topic of my presentation is how financialization will transform corporations, and we will try to discuss of the costs of capital inside the post-Keynesian theory of the firm. Even though I'm alone to present you this works today, it is the result of lots of collaborations along the years, because I was involved in different research projects. The first one is my PhD thesis under the supervision of Laurent Cordonnier and Frank van de Velde. The second project was a collective research project financed by the CGT, the main French union, and the third project was involved with the Paris Catholic University, which called the Collège des Bernardins. And in this different project, I worked with different co-authors who I will allude to along the line of this presentation. So I will give you an hint of different publication of these different researches, because they are in English, most of them, and even the second one here is available in Spanish. So if you have difficulties to follow what I'm saying with my bad English, maybe you can refer to these references for going further in details around what I'm saying to you today. So I will skip this a bit, but if you read French, there are also books published in French on the cost of capital, or a book published in France in French also on what is called here l'entreprise liquidée, the liquidity corporation, which was published with Tristan Aubray and Sandra Rigaud from Paris University. So As an introduction, I will be either very short or very long, it depends, because my introduction could be only this slide, or it could also be the whole first part of the presentation, because I will need some time to try to define financialization. When you speak about it, you need to try to define it a little bit, because it's often used concept, but the definition of financialization are not always very precise. So I will start to try my definition of financialization as a first part of this presentation. The second part will be to try to make an update of the post-Keynesian theory of the firm inside this new context of financialization. And the main result, of course, is that financialization will lead to a slowdown in capital accumulation. The third part of my presentation will be a brief clarification of the macrodynamics of financialization. I'm more a macroeconomist than a microeconomist, so I will try to say a few words on the macrodynamics of financialization, because I know we are here in a seminar on microeconomics, so I will keep it brief on this third part. And the last part of my presentation will be to speak of our new indicator of capital costs. So the attempts we made with the French Union, with the CGT, to build an overcost of capital indicator for the French case. So to begin with, the first part of my introduction, which could be understood as the long introduction of my speech, finally. It's the part dedicated to the definition of financialization. And I will do it in 3 moments, 3 little parts. As a first graph I will show you here, I wanted to share it with you, is a graph I made with Google Ngram. I don't know if you know this tool, but it's useful to sketch the frequency with which a word is used in a specific literature. You can change the literature from one language to another one. You can change the year for which you want to study the evolution of the use of a precise word. And here I made an experiment with the label financialization and the label financial liberalization, financial deregulation, and financial globalization. What I think is interesting here is that you see that financialization is the last word to emerge in the literature. First, when we were speaking of the institutional changes surrounding the 80s, we were speaking with financial liberalization, financial deregulation, or financial globalization. And I don't make an important research on this question. It's just a rapid graph I made for this presentation, but I wonder if there is something important behind this graph or not, because maybe financialization is just a new word which imposes itself at the detriment of other expressions, such as financial liberalization, financial deregulation, or financial globalization. Or maybe this graph tells us something bigger, something else, which could be that to operate financialization needs first that we have new regulation and we have more international capital mobility. So maybe it's more important than just a change in word, but I wanted to share with you this graph. So to go now to the different definitions that you can find to the financialization, I go back here to Stockhammer definition. I won't read everything here. I just want to stress that for Stockhammer himself, financialization is something that it is ill-defined. It's difficult to define financialization because it conveys very different realities. So it's always difficult to define this concept. Other definition I can use here are the famous one from Krippner, Epstein, or Paley. The old definition by Paley, because Tom Paley just published a new paper on financialization and what he calls the Empire Creed economics. So here's the definition of Krippner. The first one on this slide is the one I will use with very few places in this presentation, because for Krippner, financialization is the fact that firms will gain profits thanks to financial activities. And in my presentation, it's not the way I see financialization. It's not the main way I see financialization. I'm more with Epstein when he uses his definition. It may be a larger definition, maybe a more blurred definition, because we have some things which may appear with too little detail in this definition. The important point here is that we have new objectives for firms, new financial actors, new institutional environments with financialization. And then you have Paley, and I like the definition of Tom Paley because he underlines, he stresses the fact that financialization is also a political matter. With financialization, you have the domination of finance, which will impose itself to the rest of the economy or even to the rest of society. You have also another definition which is always quoted. It's from Van der Swan in a survey about financialization, and it stresses here another point I want to use in the presentation today is that financialization may also concern what she calls the financialization of everyday life. So financialization is not only about firms, it's also about households, but I won't speak of this today. So for today, my definition of financialization is a kind of mix of the previous one. I will study financialization while saying that it refers to institutional reforms leading to the domination of financial actors, financial markets, and financial objectives in the decision-making of private economic actors and governments, even though this last point, the modification of government policies won't be studied today. So the second point I wanted to stress in this first part is the cyclical history of finance and capitalism, or maybe of finance inside capitalism. Because if financialization is a new word, it is not an unprecedented phenomenon. Because our period of financialization resembles to the financial capitalism of the beginning of the 20th century. If you take the long waves of capitalist development theory, which can be related to Minsky or Polanyi, you can say that history repeats itself. And I stress here the paradox of tranquility of Minsky. You can read it in the long period to account for the history of the long 20th century. You can also refer to Polanyi and his alternate phases of embeddedness and disembeddedness to understand the place of finance inside capitalism around the longer 20th century. So I could make this history while speaking of these different phases, the different phases of long waves of capitalist development, I could speak of industrial capitalism in the Industrial Revolution period, where profits were reinvested. Then you have the second phases with the financial capitalism of the Roaring Twenties, where the profits of firms are mostly distributed to shareholders. And the third phases will be the Fordist capitalism, what Polanyi called the Great Transformation, with, again, this time profits are reinvested. We will see this next in the presentation. And the phases we are living in, the financialization period, since the beginning of the 80s, where, as the French author Olivier Favreau called it, the Great Deformation, with the end of the Fordist compromise, which was underlined by the regulation school. And again, profits are distributed to shareholders. So the use of profits by firms is a kind of mark you can put on the long history of capitalism and the place of finance inside capitalism. I could come back to this slide if needed in the question. I prepared lots of slides and I won't have time to comment every one of them. But if you want to come back to this, what I called the Victorian compromise, please feel free to ask questions at this point in the question. So I also use the beginning of my presentation to try to make the main point of this presentation while you are still listening to my bad English and you are not tired of my bad English. So here you have 4 graphs. I won't comment each one of them in detail, but the interesting points on this 4 graph is that every variable present here have the same shape, the same global shape. You have for every variable a U-shaped curve for everything which is represented here. What is represented on these graphs, it's in red, in the dotted red line, an index for financial deregulation. In the blue line, you have wages in the finance sector. In the red line on the upper side of the slide, on the right upper side of the slide, you have the inequality index coming from Piketty and says data, the top share of the top 10% share of the richest households in the US. On the bottom left corner, you have the share of dividends in national income in the US, again, a U-shaped curve around the whole period. And on the bottom right corner, you have 2 variables. In a range, you have the frequency of financial crisis, and the dotted black line is an index of financial of international capital mobility with the data coming from Carmen Reinhardt. So if you look at all these 4 graphs, you have U-shaped curve. The value of the variables are very high in the beginning of the 20th century. Then there is a reflux with low values for the variables. And since the 80s, again, you have high values for all these variables. So you have this kind of repetition of history, financial capitalism of the beginning of the 20th century, and then financialization period, which is the results of the end of the graphs. So with a rapid reading of this graph, we can state some important facts. If you have a deregulation in finance, if you have more liberty given to finance, you will have more wages inequalities, more incomes inequalities, more financial crisis. But the important point I want to make today, it's not on the upper part of this slide, it's the last point. With a deregulated finance, you have less productive investment for firms because of shareholder pressures, which forces firms to select only investment projects with the highest profitability. So that's the point, the main point I want to make today. But with financialization, there is also all the effects that have been showed here. Again, if we have time later in the discussion, maybe we could come back to this kind of slide on the question of why we moved from the golden age of capitalism period, the financial repression period, to the new financialization era. So the causes of this evolution, with John Kenneth Galbraith's prediction, I find it really funny, but I will comment on it if we have time later on for the questions. So the last point I wanted to make as a first part of this presentation concerning the definition of financialization is the question of the institutional reforms which are needed to make the environment evolve, to make a new environment for financial markets. I won't take too much time on this point because depending on the countries, the national reforms are very different. You can have a financial deregulation which is built in different countries at different speed. So I won't quote every national reform which have been made in this direction. But it's important to bear in mind that behind financialization, you have political decisions. You have evolution of the institutional environments, and that is precisely what makes financialization possible. So it's political decision at the beginning of the process. You have also international reforms which make financialization possible. You have also international trends such as the end of Bretton Woods, with floating exchange rates, and so the need to ensure economic actors to protect themselves from variations in exchange rate prices, or also the release of administrative controls on interest rates, which also creates new activities for financial markets. And another international trend that fuels financialization is the growing of savings, since with more savings, you have more financial activities for financial markets. But I could also take more time if you want to speak of this in the questions. But the main teaching you can have from this international trade is that financialization is not a question of individual shareholders who want to invest their money in family firms or in dynastic firms. When you want to have in mind the main character of financialization, it's not the individual shareholder, it's institutional investors. In some countries, it will be insurance companies. In other countries, it will be pension funds, depending on the financing of their social system. But when you speak about financialization, you have to have in mind institutional investors. And the money collected by institutional investors has undergone a huge surge in the last decades. You can see it on this graph. You can see the evolution of assets collected by insurance companies, pension funds, and investment funds. And it's clearly on the rise, but with differences in different countries. You have here in United Kingdom the presence of both insurance companies in blue and pension funds in red. But for France, for example, for my country, we don't have any pension funds because retirement is funded by a pay-as-you-go system. But if you look at this graph, you should immediately feel there is a ghost in the room, because in the ranking of the different countries, there is a big absence. The absence is obviously the United States. If you had the United States institutional investors to this graph, you can see that nearly every other country disappears from the picture. So if you want to understand how financialization works, you have to remind that financialization is led by American finance. It is led mainly by American pension funds. And it's through the practices of American pension funds that you have undergo all around the world a kind of uniformization of firms' policies. It's because American pension funds requires firms to exhibit huge profitability, that these profitability requirements have been spread all over the world, because investment funds are in competition to attract saving, and they have to deliver the best profitability to their clients, and it leads to this kind of new uniformity, this new dogma in financial markets, which pressure firms. And that is precisely what we try to see in the next part of this paper. So in the question, if you want, we could go back to this question. We could speak of the short-termism of financial markets, if you want, with the huge reduction in the average holding period for a stock, be it in the US or in other countries. But I will maybe move more to the next part, so as not to waste my time on this question and to speak more of the post-Keynesian theory of the firm. So the sum up maybe of this question is given by Lazonik and O'Sullivan in a paper which is very, very interesting, which was published in 2000, so 21 years ago now. And for financialization, maybe the new doctrine, the new way to manage firms is now what it is called downsize and distribute. With this new pressure from institutional investors, now firms are obliged to downsize, that is to say that they will operate only investment projects with the best profitability, and they are obliged to distribute the profits which are no longer needed to finance important investment projects. Of course, with financialization, there is also an opportunity side. It's not only a new constraint for firms, and that is what was in Gripner definition. I remind you earlier in this presentation, but I prefer not to enter more into detail on this point. Again, if you want, we could discuss it in the questions, but for me, financialization will be more a renewed constraint for firms than a new field of opportunities of firms. So now we arrived at the second part of my presentation concerned with the post-Keynesian theory of the firm itself, and I will take two moments to speak of it. The first point will be to recall its Galbraithian roots, and then we will see how financialization will modify the traditional framework of this post-Keynesian theory of the firm. So for the Galbraithian roots, it's important to remind that the post-Keynesian theory of the firm was built during the golden age of capitalism, during the era of the technostructure. And we are analyzing, we are studying a big conglomerate corporation with pricing power. And its referential point, which is often present in post-Keynesian works, we are dealing with imperfect competition. And what is interesting for me in the post-Keynesian literature on this question is that you have a joint determination of pricing and investment policies with managers who are trying to maximize firms' growth. So this joint determination of pricing and investment policies at the microeconomic level echoes to what is often used in post-Keynesian macro model with most notably the Keynesian model of growth and distribution. So this link, pricing and investments, echoes the link at the macroeconomic level between distribution and growth. And the model I will use in this presentation comes from Adrian Woods in a book in 1975. And this model is really easy to use because it relies only on two frontiers. What he calls the expansion frontier, which gives the limits to profitability, and what he calls the finance frontier, the limits to accumulation plan. So Adrian Wood's book is really is widely quoted in post-Keynesian theory. It was reinterpreted by Marc Lavoie in his book of 1992, and it's just a little evolution compared to Wood, but I will here follow the Lavoie presentation of Wood's theory. So it's a kind of adaptation of Wood's theory. So the first part of Adrian Wood's model is the finance frontier. So it's only started with a simple equality between sources and uses of funds. You have here the equation with slightly awkward expression. Here you have pi minus ID, which is profits minus interest on debt. You have here excess high, which is new equity issues. Here you have XD high, which is new debt issues. So on the left-hand side of this equation, you have sources of funds. And on the right-hand side of this equation, you have uses of funds. Firms try to invest in physical equipment. High. You have financial investments, XFI times high. And you have here dividend distribution. So in the end, after a small modification, you can arrive at the dynamic version of the equality between sources and uses of funds, which is here the equation of the finance frontier, where R is the profit rate and G is the accumulation rate. And what it is important here to notice is that the more a firm desires to grow, the higher the G, the higher the profit rate has to be. So it's basically a finance frontier, which means that to grow, a firm needs profits. And the second element of Wood's theory is what is called the expansion frontier. It is here a limit to profitability because of competition, because of the strength of demand. A firm cannot expect to reach a better profit rate than what is given by this expansion frontier. Because if the firm wants to grow faster, it will have to decrease its prices, which means it will have to decrease its profit margin here with the consequence of a drop in the profit sharing value added pie. So in the end, you have a drop, a fall in the profit rate also, if you want to express it in the profit rate. So the expansion frontier in Wood, as it is interpreted by Marc Lavoie, will give birth to concave relationships between accumulation rates and profit rates. In the end, the famous graph of the post-Keynesian theory of the firm by Adler and Wood is the following. You have the straight line, which is the finance frontier, the curve, which is the expansion frontier, and the area with the minus here stands for unsustainable accumulation path, because for this accumulation rates, you don't have enough profits to secure financing for your accumulation plans. So you cannot bear this kind of investment plans because of lack of profits. And the area here with pluses, it means that firms cannot reach higher profit rates than what is given by the expansion frontier. So the area with pluses is also something that firms cannot do. And firms can only locate themselves inside the blank area here between the expansion frontier and the finance frontier. And post-Keynesian economics, during the golden age of capitalism, will state that managers will try to maximize growth, will try to implement the biggest investment plans which are allowed for by the finance frontiers, which means that the firm decision will be this point, G star, hoping for a profit rate of R star. So that was the traditional situation for the post-Keynesian theory of the firm during the golden age of capitalism. We have the maximization, of course, under the constraints of financing. Again, I use Lazonic and O'Sullivan, who are very talented to sum up what is at stake for firms at this period. The logic was to retain and reinvest, retain profits and use them to reinvest to grow faster. So this kind of theory is accurate to describe what was at stake during the golden age of capitalism, during what is also called managerial capitalism. But with financialization, we have to take a new step, because some modifications are needed to account for the new reality undergone by firms. We could also say a few words on the question of the separation of ownership and control for Berland means or Keynes in the question if needed, but I will have to skip this for not wasting my time on this question for now, because I think I already used most of my time. So the modification of the traditional framework which are needed to account for financialization. There are different attempts which were made by Stockhammer, Lavoie, or more recently by Joel Rabinovich. And the results which are expected are three there are three main results. You expect increased distribution of dividends, reduced productive investments, and eventually increased financial investments. But as I said earlier, I won't speak of this third point today. The model of Stockhammer is a simple model, is not totally linked to what I said on Wood's diagram. It uses a utility function where financialization is seen as an increased bargaining power of the shareholders at the expense of managers. And so firms' policy will be more oriented towards profitability than growth, but it's a kind of ad hoc phenomenon since the utility function was meant to produce these results. So I prefer to use a different method here to underline how financialization will move the decision of firms while moving the two frontiers. But we have to distinguish several cases, different cases. The first one will be to assume that firms' management is still Galbraithian. You still have an old school management in the firm, an old school manager who is dedicated to promote growth, and he faces a renewed constraint to deliver more profits to shareholders. But then we will have different cases where this old school manager has disappeared, where this old school manager has been totally gained towards shareholders' interests, and then the firms will be ruled totally in favor of shareholders' interests. But then we will have to ask what is precisely the interest of shareholders, and we will have again different cases. So the first cases is the Galbraithian firm. There are still old school managers. There are still managers who try to maximize growth, but they face a new constraints. They need to distribute more dividends. They need eventually to proceed to share buybacks so that the finance frontiers moves up. As a consequence, you will have for the firm a reduction in accumulation plan, and this is seen here with the G2 accumulation policy decided by the firm, with a better profit rate expected thanks to this selection in investment projects. But if the firm is still ruled by Galbraithian managers, these managers may try to transfer the burden of change to workers. That's what I call here risk transfers, where the management will try to impose to workers wage pressure, drops in W in the equation above, or the management will try to impose productivity gains to make works intensify with increase in productivity gains in mu here. And in both cases, it allows the firm to move upwards its expansion frontier to be more profitable than before. And then the previous accumulation plan remain available despite the increase in the finance frontier. So if you have a firm which is still ruled by old school managers, you may expect a moderate decline in accumulation, or even sustain the same accumulation plan than before. But if you have now the firm which is fully ruled by shareholders, by managers who are supportive of shareholders' interests, then you will have more important reduction in accumulation plan, depending on the objective you think shareholders are following. So they may try to maximize the profit rate, they may try to maximize the cash flows, they may try to maximize firm's value, and you won't have the same reduction in capital accumulation in the different cases. I won't elaborate more on this point because it was the subject of my paper, the review of radical political economics. But what you may expect is that if shareholders are trying to maximize cash flows, you have to expect a huge reduction in accumulation plan, because they don't bother with growth. They only want to maximize the cash flows that they could claim as dividends, and they will provoke a very important reduction in accumulation plan. That's what this graph represents. If shareholders are trying to maximize the cash flows they could claim back as dividends, you have to expect this accumulation plan with a very important reduction in growth, in firm's growth. But shareholders may also have another target in mind. They may try to maximize their wealth. They may try to maximize the unit share price on financial markets. And if you follow the capital asset pricing models, what could be the most used tool by shareholders themselves to represent firm's value, you cannot neglect growth anymore, because growth becomes a component of the firm's value, most notably because growth is needed for tomorrow profits. If you think that the firm's value on the markets is the discontinued sum of future cash flows, the future cash flows need growth to exist. So you cannot suppress growth, present growth, if you want to spare future profits. But it is very difficult to maximize this equation, which is here. And then you have to rely on a financial convention, which may be represented here by the 15% of return on equity, which will be placed here with this kind of accumulation plan. So if the firm is ruled by shareholders who try to maximize the share price, they will be obliged to consider a more important growth than if they only try to maximize the cash flows. So this new post-Keynesian theory of the firm, or this update of the post-Keynesian theory of the firm so as to account for financialization, leads to what we said earlier. We have to expect a reduction, more or less important, depending on what is the social class leading the firm, but we have to expect an important or less important reduction in accumulation plan. But the macroeconomics of financialization is also important to discuss. Sadly, I think my time is short, so I won't speak of it at all. This third part, but I was prepared for this eventuality because I know we have to speak foremost of macroeconomics. But if you want, we can go back to this kind of graph. There was lots of graphs earlier in the question. The last point I will make, but I will make it quickly, is the French case study on the question of the cost of capital. So it's the part of my works which comes from a research project financed by the CGT, the French Union, and the CGT was trying to oppose employers' unions who always complain about labor costs. Workers' unions were trying to oppose an argument based on capital cost. And we try to produce a clarification, a new definition of what is the capital cost. In finance theory, the capital cost is the required remuneration of capital for shareholders and creditors. But this is not the perspective we chose. We try to distinguish different types of cost of capital. The first one is the economic cost of capital, which is the cost of acquiring productive capital, investments, worth fixed capital formation, simply. The second cost of capital we try to define is the financial cost of capital, which is the sum of financial charges, net interest and dividend payments, sum of financial charges which are necessary to finance the acquisition of productive capital. And what we call the other costs of capital refers to what could be called an excessive financial cost of capital. It means that when shareholders and creditors finance a firm, they produce a service for the economy as a whole, because liquid savings are transformed into available financing. And this production, this financial production, requires remuneration for shareholders and creditors. And this remuneration is simply the cost of financial intermediation. And if shareholders and creditors have a bigger remuneration than this cost of financial intermediation, then we call it rent, we call it another cost. When they earn more than what they produce, we call it another cost. So we can represent these different types of costs in a balance sheet perspective. Here you have a productive capital, so we set of building, infrastructure, machinery, equipment, and so on. And what we call the economic cost of capital is simply investments. It means the spending necessary to replace or to increase the productive equipment. What we call the financial cost of capital is the sum of dividends and interest paid to creditors and shareholders, but we subtract to this interest and dividends paid to shareholders and creditors the interest and dividends received from financial assets. The purpose here is that when you found funds, these funds are not only used to buy productive capital, these funds are also used to buy financial assets. So we have to subtract the dividend and interest paid to creditors and shareholders from the interest and dividends received from financial assets. And what we call the over cost of capital, it's the total financial cost, interest and dividends paid, minus interest and dividend received. But we subtract from this financial cost of capital the cost of financial intermediation, what is referred here as entrepreneurial risks and administration costs of finance. And we then arrived at the over costs of capital, what we could also call a pure financial rent. And we try to express it at a ratio so as to make a better statement. I could also tell you in the question, if you want, how we measure all the variables needed to arrive at this indicator, but maybe the thing that is now interesting is to see what is produced with this indicator. So I show you the graph here. You have the cost of capital, the total cost of capital, which is the plain black line here, and the dotted gray line is the over cost of capital, while the plain gray line is the justified cost of capital, the cost of financial intermediation. And what you see on this graph is that the evolution in France between the 60s and nowadays are given by the evolution of the other costs of capital. The cost of financial intermediation, or what is called here the justified cost of capital, remains mainly constant. There are very few variations in these costs. What is really trying to increase is the over cost of capital, mostly between the 70s and the 90s, and then you have a stabilization on a high plateau. But the indicator of the cost of capital can also be studied in different steps. You can decompose the global evolution between the evolution that is due to the rise in interest payments and the one that is due to the surge in dividend payments. And you can then tell the story that undergo French firms, which is that during the 80s, during the beginning of the 90s, the financial constraint of French firms was first tightened because of monetary policies, because of the rise in interest payments. And it is in the second time only than the surge in dividend payments tightened their financial constraint. But you find finally the rise in the profit distribution, the change in the use of profits. So profits go more and more in dividends and less in investments. So you find finally what was labeled downsize and distribute by Lazonic and O'Sullivan. We try also to measure the same kind of indicator for different countries, here for United Kingdom or United States. What is interesting is that the two indicators reveal the same tendencies, the same trend for different countries at the beginning of the period, and at the end of the period you have more differences in the different countries. But we think this indicator may be helpful to enter the public debate, because, and I may end my presentation soon, but I wanted to here allude to another indicator that was made by Michel Husson, which was sadly a French economist that passed away this summer, and he built another indicator to measure financialization. He takes as an indicator the share of operating surplus which is not invested, and you see here the evolution of this indicator in France from the end of the Second World War to nowadays. And this indicator is really helpful if you compare it to unemployment. When you draw this indicator of profits that are not invested and you compare it to unemployment, you see some great correlation in different countries: United Kingdom, Japan, Sweden, Italy, France, maybe less in the United States. And it is the mark which lays financialization on unemployment. Financialization is really damaging to economics, to national economies, and here you have the mark of it. And as a conclusion, since now I'm starting to take more than my time at what was given to me, you have as a conclusion the dire consequences of financialization, which led to more instability, to less productive investment for firms, more unemployment for workers, but also wage moderation. I don't talk about it today, but we can also discuss it in the question. More inequalities in society because of different phenomena such as merger and acquisition with increased concentration or unequal distribution of shareholding. But financialization is not a natural phenomenon. I said it earlier. It is the consequences of political decisions. And if you try to see who supports this process of financialization, you won't find lots of people. The political support for financialization is very reduced because who benefited from financialization is not a large share, a large part of the population. But the political support for financialization is nevertheless powerful because the wealthiest of our citizens who benefited from financialization finance also a political campaign. So it's very difficult here to see hopeful prospects for an evolution in this domain. But I wanted to finish my speech on a more hopeful perspective, because financialization partly relies on false premises. The claim that the firms belong to shareholders is juridically false. Robert, Blair-Anstut, and Ireland shows that in before the year 2000. And if you follow this line of research, profits are not the income of shareholders, but the profits result from a collective production, and undistributed profits, retained earnings, are in theory, and it's important to stress the in theory, profits are in theory, undistributed profits are in theory, the income of this collective entity. And it was already underlined by Heckner in his works on the megacorp and oligopoly. And it's this kind of representation of undistributed profits as a collective income, as the income of the firm itself, is present in the classical distinction of national income. When you look at Anglo-Saxon national incomes, you have the distinction between unearned incomes and earned incomes. Unearned incomes are incomes stemming from poverty. Earned incomes are incomes stemming from activity. And you find again what is a long battle in history, the fight between activity and poverty. It was already the case between landowners and industrials in the 19th century. And nowadays, it is between financiers and workers today. But if you look at this division of national primary income, you see that rents are the income of landowners, interests are the income of loans owners, dividends are the income of shareholders, mixed income are the income of managers, finally, but undistributed profits, they are the income of the firm. They are the income of enterprise, the collective nature of enterprise. Wages are received by laborers, by workers, and production taxes is income of the state. So if you take this simple division of national primary income, you see that undistributed profits are the income of enterprise. And it is precisely this type of income that has been completely vanished by financialization. So financialization, for me, I started with this earlier today, financialization has attacked the firm. It is not an opportunity, as could be the case in Krippner's definition. For me, financialization is an attack to the firm because it attacks undistributed profits. So I will stop there. But if you have questions, please feel free to ask. And thanks again for your attention. And I hope that my English was not too bad and that you managed to follow what I was saying in English. Thanks again.
Your English is pretty good. It's pretty good. Thank you very much, Professor Dallery. We are now in the second part of this presentation. I want to give you the word to Professor Leonel Corona. Profesor Corona, ¿nos escucha?
Sí, los escucho.
Le voy a pedir, a ver si puedo abrir su video porque no lo vemos.
Yo lo abro aquí.
Ok, perfecto.
Ya. Yeah.
Listo, doctor. ¿Tiene usted el escenario? Adelante, ¿no?
Muchas gracias. Muchas gracias por la invitación a participar en este evento de la economía heterodoxa.
Doctor, perdón, todavía no lo vemos. No sé si pueda...
Es que no sé qué pasó aquí.
Ahí está, listo.
Está listo, sí.
Perfecto.
Quería agradecer la invitación a participar en este evento que ha sido ya tiene su propia trayectoria sobre la economía heterodoxa y la participación del doctor Dallery da una serie de elementos muy importantes que nos ayudan a entender lo que está pasando en el mundo y en especial algunos aspectos de lo que está pasando en nuestro país. Mi comentario que quisiera hacer respecto a la presentación del doctor Dallery, que es muy completa, puesto que lo ha manejado tanto a nivel macro como a nivel micro, quizás me atrevería a comentar que ahí el aspecto de la institucionalización a la que él se refiere, eventualmente la podríamos poner en un nivel meso. Pero es una propuesta que le hago al doctor Dallery y ya veremos qué es lo que responde al respecto. Otro punto que creo que es también muy importante es que quizás en el conjunto de la presentación, dividiendo entre lo macro y lo micro, y bueno, subrayando bastante bien lo micro, se pierde esta situación, o creo que no aparece de manera clara que la financiarización. Bueno, yo no sé si hablar en español o en inglés.
No, yo creo que sería en inglés. En inglés, por favor, sí, doctor, porque si no, no lo va a entender.
Sorry, thank you very much, Dr. Dallery. My first comment, I will put it again. That I think that you are going from macro phenomena and then in macro and then micro. But I think that many of your points are in the institutionalization of the financialization, as it becomes difficult to say the two words together. And I suppose that this must be in the level of meso, the institutions more in the level of meso, and I think that could help maybe better to see institution that works directly in the firms, others at the micro level, but the change in institution is much more intense in the meso level. This is just one proposition to Dr. Dallery. My second point is related that I consider that any of these processes, the production, must be connected with this circulation of capital. Because if we lose a little bit this aspect, I think we are not taking in account other phenomena that you put aside, many of them related with the circulation of capital, in which one of these, I could call it the penetration of financialization in the production process. Let me give you just one example. Is, for instance, many firms, many productive firms delay the payments to the procurement the procurement firms. And then in that way, they are financing itself a deal part. And this is, I suppose it's happening in many countries, but especially important in Mexico. And that's, and there are other aspects also, the delay in which this financialization comes into the process of production itself. This is related with this aspect that I think we have to see the circulation. Because what is happening, I suppose, and I agree with this colleague that is working on this, also these aspects, Krippner, that you mentioned that you don't agree with her definition of financial service as part of a sector, but it's also an important aspect to consider this question of the division of labor that he mentioned in her writings, because what I don't see in the literature is that there is a division of labor, of course, considering the classical concept of Smith, but also there is a division of activities in the financialization. For instance, a passing for the 2008 crisis, it has been a development of the not working capital, but it was there were a lot of mechanisms in order to have a value, and then this is I think it's a division of inside the same circulation of capital in the circulation. Then I will come then with this micro aspect in which you consider the concept of class between shareholders and managers. I think that it's not a good conceptualization, because I think it's much more better that as I listened now, between the financiers and the workers, there is a struggle, but the main struggle is really not between shareholders and managers, as you also mentioned some different kinds of relationships. And then from that, I would like to ask you that maybe many of this theory is very much related with large firms, but what will be this is a question, what will be, how will this will work for the small firms, the small enterprises? Then the size of the firm, I think, is an important aspect to consider, because they have different powers and there are different controls. And also, this could be also related to the value chains, and now the international value chains, because there, really the small enterprises are losing a lot of control of this financialization, but it's much more controlled by the big firms, or depending on which chains, it is the last product which control it, or maybe intermediate, or maybe from the design in another. Then I think would be considered maybe this as a question, how it is related, the financialization theory with the value chain. My other remark is I do agree very much with this aspect to put this this concept in the theory of long waves. I do agree a lot with this proposition you made. But I would like to make a big question that I think you could have a lot of tools to and thinking for to answer. How do you see we are now in a long depression since 2019? And they are the expectation that this would grow, but I personally think that it's important to put the question: what will be the changes, the main important changes, as you mentioned in one of the last diapositives. About this struggle that would be between workers and the capitalists, because I think this is one of the more important changes that we have to come, because now we are not just losing jobs because this financialization, as you put it, as you mentioned it, but also by the changes in technology and the innovation and the automation of the production process, and at the same time, the more automated, which is the financial sector, is the more automated of all of sectors. Then, what changes do you think we'll have to expect with institutional changing? Will you think to expect, in which certainly the states more agree on that, and I think that's a very important hypothesis of your work, that the political decisions are very important to this process. And then I think the question of accumulation maybe is related with a very specific aspect of how much to invest. But I think there is also accumulation of capital in the financial sector. And in the financialization, maybe there are more accumulation of capital, and then there is a threshold to that second part. And I think this maybe you can give us a little bit more explanation about this transfer from the production capital to the non-financial. To the non-financial sectors, or and more specifically to the financial institutions. Then let me just ask, profiting that I'm here as a commentator, and you are with this very good research you are making. Maybe you don't have the context of Mexico, but I will ask you something that is important for Mexico. Do you ever think that corruption could be a kind of this financialization process? And I think that will be my whole comments, Dr. Bustamante. Thank you very much.
Thank you very much to you, Professor Corona. It was a marvelous comment. And I want to ask Professor Thomas Dallery if he wants to react to them. Maybe yes, of course. You have the word, Professor Dallery.
Yes, thank you for these comments. I try to answer. I take some notes on this interesting question and remarks. So I will try to make answers on these different points. Please feel free to ask me again if I forgot one of the questions on which you want me to react more. So on the first point, I agree with you. When I'm studying financialization with my post-Keynesian lenses, I'm always starting from macroeconomics and then I go down at the microeconomic level. So this is a kind of perspective we observed in France in the post-Keynesian networks. That's what we call the macro foundation of microeconomics. So it starts from the macroeconomics, and then it constrains what individual firms or individual households can do. So it's not the way the mainstream thinks. When you in the mainstream you try to talk about the micro foundation of macroeconomics, we are on the exact opposite of this perspective. And in France, not in the post-Keynesian networks, but in the regulation school, which is still very powerful, there are lots of people who try to settle this kind of mesoeconomic analysis. And we have a fruitful discussion, fruitful exchanges between post-Keynesianists, post-Keynesian economists, and regulation schools. Robert Boyer, Michel Aglietta, or other regulation school theorists will try to underline the importance of institution of mesoeconomic analysis. So I totally agree with you. It's a way to present what I told today on this presentation. On the question of the circulation of capital circulation between sectors or between firms, I worked with a colleague of mine, with Jordan Melnies. He is also in the University of Lille. He contributed to the research project with the French Union, with the CGT, on the cost of capital. He made his thesis in the same years as me, so we are close colleagues. And we made an article on subcontracting. And we show how in France, subcontracting relationships impose to the firms which are the word is electing to me. The client's firms impose to its providers price cuts, plus to take some profits and make them going up in the value chain. So we have studied this point in France, and it's a strong practices by big firms. So you have not only conflicts between social class, managers and shareholders, or managers, workers, but you have also conflicts among firms, between subcontracting firms and the order givers firms. So you have also this kind of conflict, and they are parts of this history. On the circulation of capital concerning different sectors, I think we may say the same thing as what is said on the question of subcontracting, because it is the moving of profits from one sector to another one. And I don't think I have time to mention this reference, but Epstein with Crotty, I think, with James Crotty, take a similar path than we did in the research project financed by the French Union, by the CGT. They try to see how much income does the financial sector receive in the United States for a given services of financial intermediation. And they see that for the same production of financial services, the financial sector in the United States extracts 5 times more incomes nowadays than in the 60s. So profits have been shifting from the productive sectors to the financial sector. So, of course, there is this kind of circulation of profits. There is this kind of redistribution of profits between firms. The subcontracting is one reality of this approach, but you have also at the more aggregated level this kind of modification of profits between non-financial and financial firms. Concerning the long waves, the actual depression, and the changing that we need to make to improve our economic situation, I think that's the starting point maybe to stop the financialization damaging effects caused by international capital mobility. I think it's the first step to be taken, because if you suppress or if you slow down international capital mobility, you will take the main weapon of finance, which is to move from one country to another, from one market to another. So you have to put some obstacles to international capital mobility, and then in a second time, maybe it will be easier to implement pro-labor policies, because if the threats of capital flights going abroad is less powerful, maybe more labor-oriented policies could do the job inside national borders. So for me, if you ask me what could be my solution, my first solution, it's in just a few months there is a presidential election in France. So if I am president of France, my first proposition could be to suggest a decrease in international capital mobility. But I'm not the only one to say this. There was some years ago papers by the IMF, which was on this question. So I think we may have gone too far on this side of international capital mobility, and we need to go back to more reasonable mobility and to more labor-oriented policies. With other colleagues from Paris University, with Sébastien Charles and Jonathan Marie, we are working currently on something which is related more or less to this kind of discussion, which is the conflict inflation framework. And we underline that in France, what has provoked the huge decline of the labor share in national income is also the vanishing support to workers' unions. So it's also it's not only to slow down international capital mobility that is needed. It's also from the workers' point of view, the construction, the building of a bargaining power thanks to unions, and I think it's also part of the solution to this kind of depression we are in. And the last point you made on corruption, so I'm sorry not to know sufficiently the Mexican situation on this side, but clearly the corruption is part of the problem, because I conclude my presentation while saying that financialization has not benefited to many people, but I said it as a powerful support because thanks to financing, thanks to the financing of a political campaign, the people who benefited from financialization may slow down economic policies that could change the deal, that could attack financialization weapons. So I think here you have something that need to be addressed through a more maybe transparent financing of political campaigns, and to avoid a situation. I don't know if it is the case in Mexico. I know it is the case in the United States, that there is a kind of legal corruption in the United States, is that you can give money to political party without limits. In France, there are limits. In France, when you lead a political party, you cannot receive more money from individual or from corporations than a certain threshold. So it can regulate the lobbying activities or the passive corruption that you could have on this question of financialization. But on the question of corruption, maybe if I can, I will share again my screen to go back to a quotation, or maybe a situation I skipped maybe too fast earlier. Is the question of John Kenneth Galbraith, which was once asked. It's this slide I skipped earlier. It's about the question of why we moved from the financial repression during the golden age of capitalism to the financialization period. And in an interview, John Kenneth Galbraith was asked, when will the next big financial crisis will hit the American economy? And Galbraith responded, 15 years after the election of the first president born after the Great Depression. And if you look at the data, Bill Clinton is born in 1946, and he becomes president in January 1993. And what happens 15 years later? We are in 2008. You have the Lehman Brothers accident. So the prediction of John Kenneth Galbraith for the next big financial crisis is pretty accurate. It's perfect, and it's not an accident that this prediction is perfect to my mind, because what is at stake in this question is that for Galbraith, when a politician, or more globally a generation of people, has undergone a crisis, a financial crisis, which was provoked by the excess of financial deregulation, such as the financial crash of 1929. You are aware of the damages brought by financial when they are deregulated, and you will resist to the political pressure to liberalize finance. So when we will have a change maybe in the leadership of politicians, maybe we will have a better support for regulation policies, because as the Clinton example shows, Bill Clinton was not aware of the damages of the it's not that it was not aware, but he didn't experience in his life the damages of the Great Depression, and he was more prone to liberate, to deregulate finance, because he didn't experience the financial crisis of the 30s. So he in politics, this question of the generational evolution is also, to my mind, important, because depending on your generation, you will be more likely to support such politics or another politics. And I think for corruption, you have something like that also, which is very important. If you live next to lots of corruption practices, you will be very eager to react to this. If you don't see them, maybe you let it go, and it will cause more damages to future generations.
Yes, thank you. Thank you.
Thanks, Professor Dallery. Profesor Corona, ¿quiere decir algo más?
I'm satisfied with the answers. Thank you very much.
Thank you very much, Professor Corona, for your comments. We are now in the third part of the session. We have some question. I'm going to put in the chat for you can read it. We have the first one. Let me copy in the chat. Okay, done. The first one is what happens with financial frontier if the firm is in an oligopoly or a monopoly structure? What happens with the resources for financing? No? Have you checked statistically the relation between asset prices, capitalization, and unemployment? This is the second one. And I don't know if Jose Carlos, do you want to make your question?
Yes, if you want, I can read it.
Yes, of course.
Okay, well, thank you for the presentation, Professor Dallery. I want to make two questions. The first one is if you have some measure of the spread in terms of the profit rate of the corporations of the financial sector and the non-financial sector corporations, because we explained that the capital mobility, well, there should be a spread of profit rate to explain that. And the second question, thinking maybe in terms of Kaleski, the non-distributed profits that you talk about in aggregated terms, they have to be expended some way, for example, in consumption or in investment. But this is also a demand for another companies, and in this regard, this consumption-led growth that we have seen, for example, in the United States, have changed the productive structure of the economy. For example, creating more luxury goods, which are not, we do not create basic industries. So probably not making more a big structure, you know, and for that we can see maybe less accumulation. Do you think that this can also explain the stagnation that we have seen in the last years? And that's it. Thank you very much.
We have another question. Let me well, I have a comment. You have built a distribution income model of between stakeholders, right? And you're talking about the trade-off between dividends policy and the growth in the context of financialization. Okay, I think dividend policy is the way that not financial corporation fits the expectations of increasing prices in the financial markets for the financial investors. Okay, then This rising prices in the financial market is the result of the increasing demand for financial assets of these financial institutions, no? And these financial bubbles allows the firms to get more debt because this increasing collateral, you know? And I have this question. Is necessary to make buybacks in the context of an increasing tendency in asset prices in the financial markets? Because I think that is a conjunctural action to retain control or to protect themselves against a takeover. This is my question. And we have another question. Let me allow you to speak. Let me find you. Give me a moment. Okay. I just say you are allowed to speak and you can ask your question right now.
Jorge, ¿me permites hacer un comentario?
Yes, of course. Professor Gustavo Vargas has a comment.
Thank you, Thomas. It's very nice presentation. I have some questions, but the first one is about your background. Is shared with me. I am from post-Keynesian theory. I agree. And the graphic about the profit rate and growth rates, see, where you find a equilibrium point between expansion frontier and finance frontier. See, I think it's a little bit a generalization, because the problem of financialization is, I agree with Professor Leonel Corona, is different for small firms, medium, big, or transnational one. For example, see, for the transnational Mexican company or international companies, I don't believe they have financialization problems. They have their own contain of money, see? And they didn't need the financial market. They participate in the financial market, in different markets, in Mexico, in United States, in Canada. But in general, see, I didn't find any problem with that kind of enterprises. In the same graph, see, how can you represent these different enterprises? Okay? One lesson of the complexity theory that already listened 1 hour ago is that the heterogeneity. See how you can represent the small, medium, and bigger firms. And the end is very strange for me. Listen, the word maximization. See, that word imply so rational performance of the agents. But I think in general is very interesting the essay to apply the financialization concept to the microeconomics. Thank you so much.
Okay.
Yeah, thank you.
I just think you have to the word. Okay.
Okay, I go ahead. Yeah, thank you for the presentation, Professor Dallery. My question, well, I have two questions. The first one is related to what Professor Vargas just mentioned, which is actually how you can reconcile the post-Keynesian framework of like the firm representation to the heterogeneity of different corporations that we see nowadays, especially when you have, for instance, like very high-tech companies that accumulate the vast majority of the profits and that actually are not undertaking regular investing projects, but may pursue other type of competitive strategies as mergers and acquisitions and so on. And actually, related to that, I had the question also of if it is possible to reconcile what you have presented today and your work on the financialization of the post-Keynesian firm with a paper that you wrote, I think it was published in 2019, that you wrote with Tristan Auvray in French, Une histoire des relations finance-industrie aux États-Unis, in which like you make this historical revision of how actually there's this dynamic and cooperation in a way between the financial sector and the non-financial corporations, and how that relationship changes through time due to regulation, but due to also the development dynamics of capitalism. And on the other hand, in this like post-Keynesian framework is very static. You only have one homogeneous firm. Well, I was wondering how you reconcile both things. And then my last question, if I may, is related to related to the heterogeneity of firms, how you can, if you see also that, because you said like for you financialization is mainly for the firm a constraint in what they can do and in what they can do with their financial resources. But for instance, I guess for sure you might be familiar with the work of Jan Toporowski, in which like he says that one of the effects of financial deregulation and the deregulation of what pension funds, especially in the US, can do is this price inflation dynamics in the stock market and in financial markets in general, and how that triggers like actually new dynamics of what non-financial corporations can do, in the sense of they can issue new equity and they can overcapitalize themselves, and then they can pursue different accumulation strategies, not only through investment in capital expenditure, but also through mergers and acquisitions and so on. I was wondering what's your opinion on this, given that I think in the post-Keynesian framework is a bit left to the side. Thank you very much for the presentation and your work in general, Professor Dallery.
Thank you for your question. Professor Dallery, you have the word.
Thanks for this numerous question. I will try to answer, but again, if I forgot one or several question, don't hesitate to ask me this question again. So I will try maybe to answer by the end with the last question on the financialization as an opportunity maybe for firms. I don't say that this aspect of the question doesn't exist, but I prefer to see financialization through the increasing finance constraint for firms based on the French experiments. Because in France, financialization was clearly a way for firms to experiment a new financing constraint, which prevents them to invest as much as they wanted. We have several examples of big corporations that were progressively weakened by this financing constraints, which has been tightened by financialization. So based on the French experiment, I prefer to see financialization from this side. But of course, the other side exists. Firms, non-financial firms, have exploited the opportunity of financialization to grow or to make their main activities evolve. In the US, for example, you have General Electrics, which is maybe no longer an electricity company. The main profits for General Electrics comes from financial activities, and to some extent in France, you have also seen some industrial companies which make more profits from selling credits to their customers than from producing their industrial goods. The French car companies, Peugeot or Renault, are in this kind of perspective for the last decades. They make more and more money from financial services than from industrial production itself. So, of course, financialization offers new opportunities for firms. And the increasing trend of financial market prices. So in France, we just overcome the last record. The French index in Paris financial markets just won a new historical record. So you have this increasing trend, which may be caused by non-financial firms trying to buy financial assets because it's easier to make profits through financial speculation than from productive activities in an economy which is in stagnation. When you have depressed economy, the way to make profits may be easier through financial channels than through productive ones, and it's a continuous attempt for firms to try to make profit where they are, to try to chase profit where they are. In France, there are in several years, but in different countries, it was also the case. Another place where you can make profits without making productive investments is housing. There was lots of bubbles in the real estate markets because some non-financial firms were trying to make profits while buying real estate, buying housing, while expecting these assets to see their value increase and so make profits from them. So it's a trend that you can find everywhere and always, but I prefer to see financialization through the constraint, the financing constraint that waits on the investment policies. But of course, you have this effect of new opportunities that are given. But I choose today to focus only on the constraint side because I didn't have time enough to develop every aspect of the question. I'm sorry if I insist too much on this side. On the question of heterogeneity, how I will take into account heterogeneity in the model, I think you can have a different position for the respective frontiers. A big corporation will have maybe less constraining financing frontiers, and a big corporation will maybe have more profit opportunities, so bigger expansion frontiers, and respectively, if you have a small corporation, the financing constraints will be steeper, and the expansion frontier will be will offer less opportunities to make profit. So in the model, I think you can deal with heterogeneity with the respective position of the two frontiers. And concerning the question of maximization, I need maybe here to confess that when I'm trying to stress the different consequences for a shareholder-ruled firm to modify its accumulation plan, I was trying to play a kind of role play, precisely. I was trying to be the shareholder. And if I am a shareholder who believe in the financial markets rationality, if I am a shareholder who believe in the capital asset pricing model, that is what I will say. That is what I will do. I will restrain my investment plans much, because I think that for the maximization of the unit share price, I have to do this. But indeed, personally, I don't believe in the capital asset pricing model. But if I want to see the consequences of shareholders' decision on firms, I have to make an assumption. I have to try to make as if I am a shareholder who believe in this kind of maximization procedure. Of course, if you follow the post-Keynesian model, maximizing is impossible because of uncertainty. You cannot maximize. But if you try to behave like shareholders who believe in the capital asset pricing model, which is maybe the most representative form of shareholder logic, there are the consequences that
Professor, sorry, we have only 2 minutes left. Okay.
So maybe if you have other question, or if you want me to ask to answer a specific question, as you want.
Thank you very much, Professor. Sorry, but we don't have time. I want to thank you for this marvelous presentation. Sorry for the time. I want to give you a certificate. I want to share my screen. Can you see it? Yeah. I want to say this. Thank you very much for everything. I hope we can keep in touch for more seminars. I want to say this. The university, the Autonomous University of Mexico, Faculty of Economics, gives you this certificate to Thomas Dallery for his participation as a main speaker in the 8th International Seminar on Heterodox Microeconomics with the lecture, How Financialization Transforms Corporation, the Cost of Capital Inside of Post-Keynesian Theory of the Firms. Thank you very much, Professor Thomas Dallery, for this marvelous presentation.
Thank you again for inviting me, and thank you again for airing my bad English. Again, sorry for it.
I'm going to send you this by email. Thank you very much, Professor. Bueno, todos me escuchan. Ahora vamos a pasar con la siguiente mesa. Le doy la palabra al doctor Mauro Rodríguez. Tenemos ahora sí que 1 minuto para empezar. Muchas gracias por estar acá ahorita, aguantar hasta ahorita a todos.
Hola, buenas tardes a todo el mundo. Efectivamente, falta 1 minuto para que el tiempo programado para iniciar nuestra mesa, la tercera mesa del día de hoy, inicie. Y bueno, de hecho, estamos iniciando. Esta mesa aborda